Hello, I'm Dr. Orville Weyrich. I have a PhD in chemistry from the University of Tennessee, and I am a naturopathic medical doctor. But today I want to talk about economics and the truth about taxes. So, basic truth about taxes, number one, nobody likes being taxed. But that's pretty much something that is going to happen. There's an old saying that says, nothing is certain except death and taxes. But some level of taxation is necessary. For example, when our country was first formed, we didn't have the Constitution. We had a form of government that was called the Articles of Confederation. But this particular form of government didn't have sufficient power to tax and basically couldn't get the money it needed to function. So our Constitution was drafted as a replacement for the Articles of Confederation. So any activity that is taxed is going to be suppressed. For example, there's a tax on tobacco and cigarettes. Partially, it's intended to raise money for the government. Partially, it's intended to discourage smoking, which is considered to be a health hazard. On the other hand, any activity that is not taxed will be enhanced. For example, tax loopholes are created to encourage certain behaviors by certain players in the economy. Now, I'm not going to talk about public policy, about pros and cons of this or that public policy, other than to observe that public policy dictates which activities will be taxed or untaxed. And tax policy ultimately determines the prosperity of our nation or any other nation. And who you vote for does matter. Elections have consequences, as it's been said. Let's look at some examples of taxes. Sales taxes are used by various cities and states as a way of raising revenue. And it tends to be what's called a regressive tax, in that it impacts lower income people more than it does high income people. And so sales taxes are not necessarily a good way to go. Use taxes make more sense. If you're using a highway, for example, you should help pay for building and maintaining the highway. And so a gas tax makes a lot of sense. Toll roads, same thing. In Europe, they have a value-added tax, which is similar to a sales tax, except in the United States, sales taxes are only applied to the final retail sale to the consumer. Raw materials are not taxed, and the partially built components are not taxed. On the other hand, in Europe, the value-added tax is a taxation on every step of the production. So when someone digs some minerals out of the mountain and sells it to a manufacturer, there's a tax on that transaction. When the first manufacturer takes the minerals and refines them to a finished element, steel or whatever, and sells that to someone who builds cars, for example, there's a tax on that stage. And so it's sales tax basically on steroids. Then we have tariffs. Tariffs are a form of sales tax, but they are only levied on other countries that produce goods and services that are sold into our country. And so we'll talk about tariffs. One political candidate is really bullish on tariffs, and the other political candidate is more in favor of income tax, especially taxing the rich so that they pay their fair share, whatever that is. Which brings us to income tax. income tax is called a progressive tax because there's a lower tax rate for lower income people, and it's a big political discussion what the maximum tax rate should be. Should people that make $1 million a year pay a 70% tax, a 30% tax, a 90% tax? But the main point I want to make is all sales taxes are regressive and affect the poor the most, whereas income tax is progressive and affects the rich the most. Then we have inflation, which hurts everyone basically. And inflation is related to capital gains and even a new proposal of taxing unrealized capital gains. And we'll talk more about these ideas. Then we have inheritance tax, which is aimed at intergenerational wealth transfer, so that if I want to work hard and save my money all my life so that my children have a good start in life, then the inheritance tax takes that money away from my children. And then there are just government regulations, which are really a form of fascism, if you really understand what the term fascism really means. Fascism is government control over private property. So anytime the government tells you what you can do with your own property, that is a form of fascism. Before we talk more about taxes, let's take a detour and let's talk for a moment about the economic multiplier effect, specifically as it applies to the United States economy. The economic multiplier effect is based on economic theories of John Maynard Keynes, also called Keynes, who was a British economist who lived from 1883 to 1946. And his theories were very influential with FDR, for example, in how he approached dealing with the Great Depression. So, for example, American workers are paid for producing goods and services that are then sold. And they get paid, and they pay income tax on what they were paid. These workers spend their money in their community, and this provides jobs for additional American workers in the community who also spend their money in their community. And they also pay income tax, so that we have a chain of people from the worker who made the initial product to a series of workers who provide support services. So I make my money as a doctor and my patients pay me. But I take the money that they gave me and I take it to the grocery store, and the people working in the grocery store get paid to serve me. And they take their money and maybe they pay for a babysitter, or maybe they pay for someone to mow their lawn. But at each step, they are spending money that they wouldn't have if I hadn't been paid by my patients. And this is the cycle called the economic multiplier effect. But the cycle can be broken if foreign goods are purchased instead of buying domestic goods, or taxes siphon off the money, take it out of the community, and therefore that breaks the cycle. Or if instead of paying people to do services for me, I take the money that I receive and pay debts, or I put it into savings, that breaks the cycle. But the importance of the economic multiplier effect is that the more economic activity we develop in this particular community, or the nation of the United States, which is a large community, the more we can keep the money circulating in our community, in our nation, the more economic activity we have, which generates more products and services and gives people more money to buy goods and services. So let's compare. Let's talk first about tariffs. So tariffs discourage the purchase of foreign-made goods that promote economic activity, not in our country, but in foreign countries such as China. And we don't benefit from activity in China, economic activity in China. China benefits. And tariffs likewise promote purchase of domestic goods and promotes domestic activity because it makes domestic goods and services relatively cheaper. It positively affects the domestic economic multiplier effect, which is good. And it allows income tax to be reduced without reduced tax revenue to the government. And it also promotes balanced trade. On the other hand, the income tax discourages domestic economic activity of both workers and the corporations who employ them. The more the tax man takes away from the worker or the corporation, the less inclined they are to do extra work because they don't get much of a benefit from working hard or investing in new plants and facilities. This negatively affects the domestic economic multiplier effect. An extreme example of how the income tax can adversely affect a community is found in the diary of Governor William Bradford, who was the first governor of Plymouth colony from the Mayflower. When they first arrived in the New World, they basically had a socialist model where all produce was shared by the entire community and nobody was particularly inclined to do extra work. And they basically were starving. And then the governor had the idea, let's try capitalism. We'll divide up the land and each family gets a piece of land and they work it and they get to keep the proceeds of what they produce and they can sell it, trade it, and so forth. But the harder a family works, more they produce, more benefit they produce, and the whole colony benefited from this and became much more prosperous. Inflation is a big concern now, so let's talk about inflation. Basically, inflation is the increasing cost of goods and services. So the same piece of bread costs more today than it did yesterday. And this is caused in general when the demand for goods and services exceeds the supply. Well, how can that happen? We'll talk about that. Inflation can drive tax increases for things like capital gains. Capital gains tax taxes the increase in price of something that was bought last year and sold this year or after many years. Now, when we have a capital gains, that is, we sell something for more than we paid for it, did we really make a profit? Well, only if the capital gains is more than the rate of inflation. If the rate of inflation is 20% and what I bought didn't really increase in intrinsic value before I sold it, I have to pay tax on a 20% gain that was really not a gain at all. And so it discourages investing in anything that when it's sold will be sold at an inflated price. Likewise, inflation can drive what's called a tax bracket creep. For example, the poorer workers in this country pay a tax rate of about 10%. But if inflation doubles the cost of everything for the workers, and inflation also doubles how much they get paid, they're really worse off because they get pushed to a higher tax bracket and they have to pay a larger percentage of their income. So tax bracket creep hurts everyone, especially the people at the bottom of the income tax scale. And of course, sales tax, if the cost of things increase, that means that the states are collecting more tax on each sale as well. Well, there's ways that we can fix inflation. Basically, if inflation is caused by more demand than there is supply, we could decrease demand. Or we could increase the supply. Those are both options. But what doesn't work are price controls, because price controls decrease supply. If people can't make a profit by making something, they're just not going to make it. So the supply goes down. Or government entitlements, where the government says, okay, we'll give you a $25,000 loan so that you can buy a house. Well, that increases the demand because more people have enough money to buy a house. Doesn't increase the number of houses, but if you have increased demand because people have more money in their pockets, then that causes inflation. So, what are ways to decrease demand? One way is to raise interest rates, and this is a very Keynesian approach that is used by the Federal Reserve, but it can risk causing a recession or even a depression. And it reduces economic activity, which means it reduces jobs. People get laid off. In a worst case, we get what's called stagflation, where the prices are going up, but wages are not. This was seen during the Jimmy Carter years. Or we can decrease demand by increasing taxes on consumers. This also reduces economic activity, causes a loss of jobs. Or perhaps we could repatriate uninvited immigrants. That would relieve the strain on the housing market. All these millions of immigrants coming into the country need someplace to live, and so they compete for the same housing that our own citizens are competing with, or competing for, and that increases demand, which drives up housing prices. Or we could decrease demand by reducing government spending. The more the government puts money into the economy, especially if they're printing it, the more demand there is. So if we stop the government from throwing money into the economy, then we can reduce demand. But it's easier said than done. It's a lot easier to pass a law to spend more money than it is to pass a law to take away spending. Okay, on the other side of the coin, we can increase supply. How do we do that? Well, we can reduce regulations. If we reduce the cost of making goods and services, we increase domestic productivity. That means manufacturers can make more product and sell it for less because it doesn't cost as much to make and it's easier to make. Or we can increase the supply of raw materials. And here we're talking especially about energy. Energy drives our entire economy. You can't make anything, move anything, without expending energy. And anything you do that increases the cost of energy increases the cost of just about everything in the country. So drill, baby, drill is an excellent way to increase the supply of just about everything in the country. Or we can reduce taxes on domestic producers. This incentivizes domestic production, makes more product. Okay, so those are pretty much the options we have. So what should we do? Well, first of all, I have to say there's no one magic silver bullet. So we need some balance of more than one approach to achieve the results we want. So one of the medical doctors that I follow very closely, who has developed very effective treatments for Alzheimer's disease, says we don't need a silver bullet, we need a silver shotgun shell that hits various different targets all simultaneously. We get much more efficient, effective results when we address multiple problems at the same time, because our solutions, our treatments are synergistic. That is, they complement each other, they reinforce each other. So we've got to do more than one thing. Just drilling, baby drill, is not the complete solution to the problem. But any change in economic policy produces winners and losers. There are some people who benefit from the current government policies, and those people are going to fight change. We also need to balance approaches to avoid unfairly burdening vulnerable populations. For example, if we increase tariffs and decrease income tax, that benefits people who work and pay income tax. But it doesn't benefit people who are unable to work and have to pay more for some goods and services. So we have to deal with these problems. For example, if senior citizens on Social Security are adversely affected by rising costs caused by tariffs, we need to take some of the tariff revenue and use it to give them basically a cost of living boost to their Social Security. We can solve these problems, but we have to be aware of what we're doing. And also, maybe we should be not so fast. There are examples in history where rapid change can be disruptive. Back in 1986, Congress passed the Tax Reform Act. But in the early 90s, this tax act caused a real estate crash because investors under the old tax plan had certain calculations as to what it would cost to do business and what the rewards would be. The Tax Reform Act changed the playing field so that the investors who had invested in various projects couldn't get their money back out and basically couldn't pay off their loans and went into bankruptcy. So we need to be a little bit aware that if we change things too fast, we can have unexpected consequences. So we have to monitor and don't go too fast. Go fast enough, but not too fast. And we also need to not overcorrect. For example, historically, there was something called the Forde-McCumber Tariff Act in 1922, which increased tariffs too much and caused worldwide distress, which contributed to the market crash in 1929 and led to the Great Depression. So we need to do enough, but not too much, and don't do it too fast. So now, I want to turn it over to you. After hearing what I have to say, what was the most important thing you learned from this video? What do you want to know? What more do you want to know? Let me know by leaving a comment on YouTube. And finally, if you like this video, please share it with your friends. Like, subscribe to my YouTube channel, and visit my website. which is drweyrich.com. When you get there, choose the Multimedia Archive from the menu on the top, and you'll find additional information there about this and many other topics. Thank you for watching.